Welcome to Simplifying the Complicated. In each episode, we'll get together with other professionals and have fun talking about trust and estate matters. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, lawgbs.com. Now here are the hosts of Simplifying the Complicated, Lori Bolander and Lauren Gallagher.
Hello, I'm Lori Bolander, and today we're unfortunately missing our co-host, Lauren Gallagher, so I'm going to do the best I can to lead us today. But welcome to Simplifying the Complicated, the show where we talk about trust and estates matters and simplify those topics around that. We are going to simplify the complicated around taxes today, everybody's favorite subject.
Mine.
Yeah, and being that we're trust and estates attorneys, we're going to be talking about specifically around taxes, around trust and estates and what trustees need to know and how that all works. Because I know when I have clients that are trustees, especially for the first time, they have no idea what they are supposed to do when it comes to taxes. So today we have two guests, which is great, especially since I'm missing my co-host. And they are particularly knowledgeable about taxes and the trust and estates arena. So we've got Daryl Golemb and Katherine Younger, both from Golemb Accountancy Corporation today. And I rely on Daryl and Katherine in a lot of my cases to help guide my clients and me in making the best decisions around their taxes. So thank you for being here. Welcome.
Thank you for including us, Lori.
Yeah, great to have you here. And so tell us a little bit about yourself. I obviously have been working with you for many years, but tell our guests or our viewers a little bit about yourselves and your business.
Ladies first.
So I've been working with Golemb Accountancy for the past 8 years, a little over 8.5 now. And so we do trust and estate taxation. We do tax returns. We do tax research. We do some accountings. We do estate tax returns, all related to trust and estates. That's our specialty. And I'm our project manager. I work with Daryl on all of our cases, and I come into this firm with a background in trust and estates. I was an estate planning paralegal for many years before transferring over into this more kind of administration side and working in the taxation side of things.
We are a CPA firm, a certified public accounting firm that specializes in estate and trust taxation and administration. That's all we do. Many other firms will also do partnership taxation, corporate taxation, but we chose to focus solely on estates and trusts because it's a very unique area that requires our full attention. I can tell by the gray hairs, I have some experience in this field. I have concentrated on trust and estate for the last 20 years. And prior to that, I was a CPA focusing on corporate taxation.
So you guys have lots of experience, especially Daryl with his gray hair. Yeah, and it's good to note that you only do this area because, like you said, it takes so much time just to stay on top of this area of taxation, I would imagine. I mean, that's how the law is, where, I hear about attorneys that, oh, I do a little of this and a little of that. I'm like, how do you feel competent in all those areas where just, this one little area, there's so much, and even on some of my cases, just how many little rabbit holes can be gone down in these specific situations in these cases where it's a whole nother thing that we have to figure out or explore or be knowledgeable in.
Yeah. Lori, we have found with CPAs that dabble in this area, just because you have the software on your computer doesn't mean that you can actually be an expert in these types of returns. We frequently have to come in and clean things up. One of the advantages of estate and trust taxation is there are so many levers you can pull that affect the outcome in the taxation, but those levers have to be applied appropriately and timely, otherwise they can't be used.
Right. Yeah. And I know
Mm.
I've encountered some of those in my cases where the client says, well, can we do this? I'm like, I don't know, because sometimes we do this and sometimes we do it another way. Like, that's not a me question, you know?
Mm. Mhm.
So, um, so one of the first things that the trustee or the estate administrator is responsible tax wise, well, I mean, first they have to get a tax ID number, which a lot of them are not aware of. But past that, usually it's dealing with the decedent or the trustor's tax returns.
Yes. So, what the trustee is responsible for is, for the first portion, filing that, preparing or having the individual income tax return prepared. So the reporting for somebody's final income tax return goes from January of their year of passing until their date of passing. So that is the individual income tax return that people file during their lifetimes. That's the 1040. It reports all the income they've received. You report, property taxes, things like that. And when somebody passes, that reporting goes through just their date of passing. That final 1040 also needs to be paper filed, can't be filed electronically, and that is to avoid fraud. That's one of the fraud
Oh,
protections the IRS
A
is.
lot
yeah.
in the area of decedents, unfortunately.
Yes. And
Interesting.
so then after somebody passes, you will have an income tax return for either their trust, if they had a trust, or their estate, if it's a probate matter, or if it's a small estate. And that will pick up from their date of passing and then report the rest of the activity for that year on a 1041.
Got it.
So that is a trust or estate income tax return. And that is just reporting income and expenses for that trust or estate.
So a couple questions.
Mhm.
One, with filing the decedent's final return, can you file that at any time? Like if they died January 31st, can you just file it whenever you have it ready, or does that have to go to April of the next year?
It will wait until the following year when the tax forms are released by the IRS, because
Right.
sometimes there are changes to the tax law toward the end of the year. And then once they release those forms, returns can be prepared. But it's very important that those two returns work together. And I think Daryl will go into that just a little bit more about how they are interrelated and need to be reported properly.
Yeah, no, they definitely are interrelated. I had a question because the bank apparently told my client when she went in, because we're now getting to where we're doing an accounting.
Mhm.
And I said, so that account's in the trust, right? And she said, oh no, that one's not in the trust. When I went in, they said the banker told me that it didn't need to be in a trust account, that it wouldn't matter.
Mm.
And I mean, that's where some of the trust expenses have been coming from. So I don't know if that is going to be a problem, like when she goes to claim these expenses for the trust.
As
Is it?
we've experienced, Lori, bankers can certainly throw a wrench in trust administrations. Everything from tax preparation to the preparation of accountings. They aren't always as cooperative as they could be.
Yes, we know that all too well, don't
All
we?
too well. As Catherine was saying, the activity for a taxpayer closes on their date of death. From that point forward, their trust or estate picks it up. This concept isn't as simple as counting the number of days before and the number of days after, because things change upon the death of a taxpayer. An easy example would be their securities account. The stocks that they hold get increased in value to the value as of their date of death.
Mhm.
And that's a really important concept, because if that stock is then sold after they pass, we have a much different gain or loss calculation. It's important that the investment company be brought into the conversation as well. When stocks are sold, the investment firms not only report the sales proceeds to the IRS, but they also report the cost basis. And if the cost basis of the taxpayer before they died is used, the incorrect gain calculation will be sent to the IRS.
Right. And I know too, like the trustee has to ask them to do that
Correct.
calculation sometimes. And I've had it where they did not do that. And then the CPA has to like calculate that
Mm-hmm. Mm-hmm.
basis. Makes it more complicated and expensive.
And the IRS tracks this gain or loss that's reported to them, and correspondents can come to say, well, Schwab said you had gain of $10,000 on this, but you reported zero. Why? And so going as far upstream as we can to get the investment firms to report the correct gain or loss avoids
Mhm.
further communications.
Yeah, I could see that.
Another issue with those 1099s is sometimes if somebody hasn't reported that death or things haven't been changed over into that tax ID number, the 1099 that's issued at the end of the year will oftentimes be reported under the taxpayer's social security number. And
Mm-hmm.
so when we talk about the interrelation of that 1040 and the 1041 return, what happens is that activity on that 1099 needs to be divided up and reported some on that 1040 and some on that 1041.
Mm,
We call those allocations. So we allocate those between the two returns. And that's one of the things that can often get overlooked if somebody doesn't have this area of expertise, because they will just follow how it was reported on the 1099. And we'll often see, I've been doing my mom's tax returns for 10 years. And so I just filed her final return. I took the forms that we received in her name and reported it. But that activity probably should have been divided up onto the two types of tax returns that
yeah, I mean,
need to
that's
be
something I've
amended.
never even thought of, but makes total sense, right?
And so we recommend that when people are looking at doing that final individual return, that they work either closely with or use the CPA who's going to be doing the trust returns, because there's so much interrelation on that final return.
Yeah, yeah, absolutely.
IRS relies on computer matching for most of their auditing. And so the activity on a 1099 would be reported in full to the IRS. What we have to do on the decedent's final return is report what the 1099 says so that the matching occurs correctly, but then back out with explanations that this activity is being reported on their estate or trust. For not only the 1099 purposes that I just described, but also the gain or loss purposes. The two returns, 1040 and 1041, have to be done congruent with one another.
Yeah, no, that's very important. I feel like I was just thinking like I should have my new clients that are trustees watch this podcast. I
Absolutely.
mean, because I don't get into this much detail with the taxes. I'm like, you have to use somebody that knows trusts and estates, and no, you can't use, Uncle Stan who's been doing taxes for 50 years. So yeah, it's just hard to impress upon them, especially if they are people that have prepare their own taxes. I feel like
Mhm.
sometimes more sophisticated people that have tax preparers kind of understand the reasoning or the logic behind it, knowing that this might be a little bit different. But yeah, it's very important, and I sometimes don't feel like I get that across to people.
Mm.
But yeah, it's important. One thing that I know we come across a lot and have had you help us with is tax research. Sometimes we don't know what has been filed, if they owe taxes, all of that kind of stuff, and that has come back to bite us and some trust administrations once we do the research. Like, oh my goodness, they owe fifty thousand
Oh
dollars.
my
You know,
goodness.
Right.
We could tell you horror stories.
yeah,
And that's our first step at our firm, that's what we recommend that everybody do. Even if they were doing the parents' taxes themselves, things like that, we recommend everybody do the tax research. So what that is we prepare powers of attorney forms for them to sign. It notifies the IRS of their role so that they are now the person responsible for that taxpayer's account. And then it allows the IRS to speak with us. And so what we do then is request transcript information. We typically go back about 5 years. And what that tells us is when returns were filed, if there's any outstanding balances owed, and what the sources of income that we're reporting to the IRS. So if they had W-2 income, if they had 1099 interest from different bank accounts. And it's important for a lot of different reasons. It's important because the trustee is, personally liable for taxes that haven't been paid. It's important to find out what those outstanding amounts may be, because they can come back later on, even if they haven't seen correspondence yet, or if perhaps during COVID they paper filed something. There was a room full of 19 million pieces of mail that went unopened for a very long time. Lots of returns got lost. And so it's important for that reason to make sure everything was filed that was supposed to have been filed. And what those transcripts can tell you when they show the income reported to that person, if there might be an account that somebody was unaware of. So there might be a little bit of interest
what I
coming
was
in.
thinking, because that sometimes, because everybody gets like digital paper, statements these days.
Right.
I was telling a client, it used to be real easy. We'd go collect the mail for a month and now we know where everything is. And that's not the case anymore.
Right.
So sometimes we do need the tax transcript just to figure out what they own.
Right.
And it's national information. So if your parents live back in Wisconsin and you have a joint account with your parents there, it's still going to show up on the transcripts.
Mm-hmm. Yeah,
Mhm.
that can be invaluable. And I've always wondered. I was glad that you went through like what that transcript shows, because I always wondered exactly what does it show on there. And so that's for federal. Can you pull like a state specific, like an FTB one too?
California receives their information from the IRS, and it's
Okay.
usually about 2 years later. What they will get are wage information and withholding, but the IRS is going to be the most timely source of information. Another thing this is used for, Lori, let's say it's known that the decedent had an account at Schwab. We see it there for 18, 19, 20, and 21, and then there's no more reporting. What happened to that account?
Mm-hmm.
The disappearance of accounts can lead to further investigations.
Yeah, that makes sense. Did they move it?
Mm,
Right.
Did somebody take it from them?
absolutely.
Mhm.
Yeah,
Yep.
because definitely seen all that happen too, right?
Yeah.
Yeah, that's yeah, the tax research can be very important and needed in so many situations, and definitely the place to start so you can know where your baseline is.
Yeah.
Absolutely. And
Catherine mentioned before personal liability.
mhm.
And at the onset, the trustee or executor doesn't have personal liability. They only have personal liability to the extent that they make beneficiary distributions ahead of the tax liabilities. So if they distribute the entire trust and then these tax liabilities show up, that's when they have personal liability.
Right. Yeah, and I know, and we've had situations where the beneficiaries are like, "Why won't you give us the
Yeah.
reserve of what we're holding back for taxes?" Because sometimes it has to be fairly large because of
Right.
what we're anticipating the taxes to be. And it's like, because as soon as I give you this money, like then we have no way to deal with this. And I mean, it's the same thing with refunds. I had a case where they wanted the trustee to just be done, and we were thinking there might be a small refund, and sure enough, that's what happened. And the kids are like, well, can't the trustee just deposit it? No, all the trust accounts are closed. And actually you asked her to resign at the end. So that you're going to have to deal with that and get appointed as trustee to get this $2,500 or whatever it is. So, and
Exactly, Lori.
yeah. And especially towards the end, because I think, first of all, trust administrations tend to take longer than people think they are going to, or should, for that matter.
Agreed.
And so when you finally get to distribution and you're holding that reserve, they're kind of like, come on, let's wrap this up. And it's like, well, I can see why they want to wrap it up, and I'm sure the trustee wants to too, but we have to make sure the trustee's covered, because that's always our job, is we're there to protect the trustee.
We want to be involved in those conversations so we know what those protections look like from a tax point of view. We cover what are the statute of limitations on returns that have recently been filed, what is the trustee's exposure there, and sometimes in situations where prior tax returns may not have included all income or some areas are gray, we want to make sure the statute expires before we say, okay, we don't have to worry anymore.
Yeah. Especially if there's some things that could be questionable. There's some that are pretty vanilla, and you're like, we're probably not going to have to worry about all of this or any of it. And there's some where you're like, yeah, we definitely have some concerns for sure.
We
So,
talked about a case where there was a professional who, upon his passing, had over $100,000 cash in his house. Where did that come from?
yeah, right.
Probably unreported income.
Yeah.
So,
I feel like that's a plot to one of the shows I'm watching. Be nefarious activity.
yes.
And then estate tax returns. So this is different than the 1041. And I mean, I'll let you explain. I won't even attempt to go into that explanation, but they're different.
Let me start with an overview. We have two separate and distinct types of tax here. Estate tax is a snapshot look at the value upon a person's passing, and estate tax rates are applied to the value of those assets minus an exemption. And then there's estate income tax, which is the income and deductions earned on those assets after the decedent's passing. So, two very distinct areas of taxation and tax rates as well.
Yeah. And the income is what we were talking about earlier. You file
Right.
the decedent's final, and then you're going to also have to file your income tax return, the 1041, for the trust or the estate.
Mhm.
And so estate tax returns can be very complicated and involved.
So the estate tax return is oftentimes needed for larger estates. So currently, the estate tax exemption is at $13.61 million, meaning that there would be taxation and consideration over that dollar amount. There is an uncertainty about that is in effect until the end of 2025, and then that can be changed. So another reason for needing an estate tax return is between spouses. So each person has that exemption right now of the 13.61 million. So a couple would have over 26 million jointly. So what happens if one spouse passes? You would file if their estate is, under that, $26 million mark, and they, the other spouse may live quite a number of years after the exemption may come down. You'll want to file the estate tax return for that person, and their unused exemption can port over to the surviving spouse. So if their share of the assets is only $6 million, then their unused portion of that exemption, the additional $7 million, will port over to the other spouse. So if, for example, the exemption after 2025 is lowered, reverts to $6 million, then when that second spouse passes, they will have that $6 million plus that unused portion of the exemption of $7 million from the spouse who passed.
Yeah, and so that's commonly what we refer to as portability, and but that has to be elected, right? It's not just a freebie. But we have a longer time period now to make that election, correct?
It's elected by filing an estate tax return, and that's a requirement.
Hmm.
Generally speaking, that needs to be filed within 9 months of the person's passing, and then an extension would give you another 6 months. The IRS came out in 22, I think, and said, wait, we realize a lot of people miss that deadline, so we've put in rules that say you have 5 years. 5 years if a number of conditions are met. It's best practices to file the return when it's due. A lot of these things have been enacted by Congress. The increase in the exemption of 13 million by default expires at the end of 25 and it reverts back to 6. Is our new Congress going to do something to reinstate it? Possibly, because we've certainly become used to very large estate tax exemptions, or not. And so, to avoid 2020 hindsight,
Right.
Daryl, why didn't you file that estate tax return to give my mom the portability for my dad's unused exemption? There's a cost to preparing an estate tax return.
Right.
It's a very small price to pay to ensure that is available for the surviving spouse.
Mm.
Yeah, and I
And
know I've seen that a lot with this, surviving spouse, that they're kind of like, well, I don't need to deal with any of that. And it's like, well, yeah, but maybe you do. Um,
Maybe you do.
and it's, I didn't realize when you elect the portability, you have to file an estate tax return. Um, but that's something, especially looking at the exemption going down, more and more people really should be doing
Mhm.
uh going forward, because you're right, we don't, we don't know. And I tell my clients that all the time, since my career, which has been 20 years next year, and I worked in this field before I was an attorney, but I mean, it's been all over the map. I mean, it was
Yes.
$600,000, and then it was
Mhm.
$1 million. Then we had no estate tax in
Right.
2010.
And for 1 year, right?
It's been literally all over the map. So we have no idea, and we can only plan for what we know today.
Correct. Correct.
But what we also do know is that it changes all the time. You
Mhm.
know, that's one thing that we know. It's not gonna never stop changing, most likely. It's probably gonna, as different administrations and Congresses come through, different ideas about taxation evolve. It's gonna keep changing.
Mhm.
Yeah.
This is an area that requires a lot of conversation, Lori,
Mhm.
because on the surface, the first spouse to die doesn't use their exemption and sends it over to the surviving spouse. Depending on the estate plan, some estate plans say that you can carve out a trust for the deceased spouse and maintain their assets there, or it can just go to the surviving spouse. There's options in there. In the case of an exemption where you're sending the unused portion to the surviving spouse, it all sounds good. The unused portion plus whatever the surviving spouse has will be plenty to offset their estate when they die. The particulars of using that amount that is ported over, if the surviving spouse remarries and the new spouse dies, the surviving spouse loses the exemption from the first spouse. It can go
Mhm.
away. So all of these things have to be taken into consideration when you say, okay, well, we're just going to give everything to the surviving spouse, or we're going to set it aside in a trust for the decedent to forever protect it.
I see. I wasn't not aware of that. If they got remarried, they can lose their exemption.
Mhm.
It's not the
Makes sense.
remarriage part, it's the death of the new
The
spouse
death of
part.
the new spouse, right? Right. Because now, yeah, it kind of makes sense. I mean, it kind of, I guess, tracks with a little bit of like the Social Security rules about spouses and what
Mhm,
they receive and
mhm,
all that, right?
mhm.
Yeah.
So
Yeah,
these are complicated concepts that need conversation.
yeah,
And I think people are often told, oh, if your estate's under 13.6 million, don't worry about it. You don't need an estate tax return. But it's more complicated than that. And especially we find in California, where people oftentimes have assets that are real property that are appreciating quite a bit. You
yeah,
can get to that exemption a lot quicker than you think. And so, depending on how many years the other spouse survives, that can be significant gain on some of
yeah.
their assets. So it's important to have those discussions, whether they think they're close to that exemption amount or not.
Right, absolutely. And like we were saying, there's a lot that goes into this estate tax return, including, if they have appraisals, if they have businesses or real estate, and those can be expensive, but we have to do
Absolutely.
those anyway because the spouse, at least for the most part, gets that step up in basis for capital gains. So it's
Mhm.
like we've got to do them anyway. So that part of it's not going to be. I think people think it's being driven by the estate tax return, but there's many other reasons we need those appraisals. I mean, there's non-taxable estates that we're doing appraisals in every day.
The
So,
estate tax return just memorializes all that.
right.
The step up occurs whether or not one is filed, but with that increase, that step up in basis, if the IRS ever questions it, you give them a copy of the estate tax return and say, "Here, it was established when my husband passed away, my wife passed away." And that
Yeah.
usually puts an end to it rather than, "Oh, let me go get an appraisal now and see what it says." It
Yeah.
memorializes that whole value as of the spouse's passing.
Yeah. If they don't file an estate tax return, is there any way for them to memorialize that step up in their own tax return? Um, or is it,
There's a couple of ways. With the investment account, they would go through the process of asking Schwab, for instance, to produce a report for the values as of the date of death. And then the next step is you have to intentionally tell them to apply that to the account. Once that's done, and this is assuming there isn't any division of assets into subtrusts, that account is okay. It's going to carry the correct values forward. For people, for purposes of real estate, I would still get house appraised even if it's your personal residence.
Mhm.
That isn't as critical, Lori, because if 3 years and then the surviving spouse wants to sell it, they could get a retroactive appraisal
Right.
and use that. So there are ways around it.
Yeah. No, absolutely.
And it,
Um,
it is nice information to have, though, because if you're looking at what your capital gains might be when you go, if the second spouse needs to be placed into a home for care, something like that, they need to know what the capital gains they would pay on selling that property. And they'll have that information if they have that cost basis. They
Yeah,
can.
no, absolutely. And capital gains are one of the big tax things that I get asked about a lot because, as you were saying, with the way real estate appreciates in Southern California, I mean, I'm in, the Point Loma OB area, and like I had a guy that bought his house here in 1936 for
Oh,
$5,400,
Wow.
$5,400. I mean, my property taxes are more than that, you know?
eat.
So, and he almost fell on the floor when we did give the appraisal. I don't know if he was not paying attention to what was happening, but he was just floored. But it's very important, and like you're saying, can really play a part in the planning
Right.
for
Mhm.
care and all of that. We just looked into one for a client, and it turns out there's lots of losses because there was just there was a federal seizure of the assets because of something that her spouse did. So, but it gives her a big deduction off her capital gains.
Oh my.
I was like,
Wow.
Oh
well,
my.
that sucks that happened, but it's really going to
But
be beneficial for this.
Right.
But yeah, there can be hundreds of thousands of dollars, and if not millions sometimes, in gains from when people purchase their property to the time of sale.
Hmm.
yeah. In
And
your example, is it now worth 5.4?
I mean, that house was pretty small, but I would bet you that it's worth probably two.
Yeah.
Yeah.
Mm-hmm. At least. And that's the thing about the beach areas. The houses are pretty small. They were meant to be beach houses. And
Right.
it's
Mhm.
funny when I have out of state clients that are like the trustee, and I had one guy, his brother passed away, and he goes, he hasn't updated that house since the 60s, and it's only 2 bedrooms, 1 bath. And I was like, well, you're going to get $1 million for it. And he's like, oh, no, we're not. And it sold for like 1.2. And he just couldn't believe it.
Mm.
He was in, I forget, Georgia or Florida or something, but he just was like blown away.
Right.
Yep. So, but yeah, important to establish that basis. And like I said, in fact, I have somebody I need to talk to you guys about with a question on that. Because it's something, the kids are looking at going, oh geez, do we have a problem here?
Right.
Um, so
Mhm.
along with taxes, there's also trust accountings. This is also something people
Indeed.
are not aware that they are supposed to do, and cannot be overstated in importance. So
Oh my
you
goodness.
guys actually prepare those,
Correct.
Yes, we do.
but they're also integral for the tax process, I would imagine.
Absolutely.
Agreed. If
Yes.
if we do those first, it condenses everything to put on the tax returns.
Mhm.
Um, and Catherine, I'll let you go into this. Many times trustees think, I'm keeping my siblings fully informed. I give them copies of the tax returns. I give them copies of the bank statements. They're fully informed. But that does not relieve them of the responsibility to report, as you know, Lori. It has to be a very specific format or it doesn't count.
Yeah.
We had a case where the trustee did that. They all got along really well, the siblings, until they didn't. Siblings demanded an accounting, and we had to go back 15 years.
Oh my gosh.
That was horrendous and expensive. But
That's
the
one of the things
response,
I say to my clients, like there's eh, kind of an ambiguity in the law where it comes to who's entitled to it, like while mom or dad is alive. And I'm like, hey, if you're taking over as trustee, you're just going to start preparing accountings. I don't care if they don't go anywhere,
right, exactly. Yeah.
but you have them
Right.
for
Hmm.
later. And same thing with children's trusts, if they're minors. Nope, we're just doing one every year because, if they turn 16, 17, 18 and they start asking where'd all the money go, you've got the answer.
Hmm.
Right.
Hmm.
Yeah, it's really important. And what we do when we send out those accountings to the beneficiary is send them with a document for the beneficiaries to sign saying they approve the accounting, they release the trustee of all the acts during the accounting that have been reported. So, from my perspective, I prefer to actually do an accounting because you can get that from beneficiaries without an accounting. But what does it really mean? If they don't really even know what they're approving, it can so easily be set aside. But when you're giving them this
Great.
detailed accounting of this is exactly what I did, I sold this, I moved that, I distributed this, I paid this person, if they've got it all right there and they're saying, I approve this, it's going to be real difficult for them to come back and try to claim that the trustee did something wrong. And again, when I'm representing the trustee, that's my role, is to make sure that I always say that you don't get sued. And when you walk away from this, you're like, I'm done. I've been relieved of all the things that I did under that, no one's going to come back and sue me.
Transparency,
Yeah.
Right.
really
Well, and
key.
the other thing I think people don't realize is the statute of limitations for suing a trustee is 3 years, but it's 3 years from the date they discover what you did.
Right.
which is another reason to give them the accounting, because it's like, well, yeah, even if you don't get a release or, approval from them, at least it's 3 years from the day you got that accounting, because that's where it was disclosed to you in. And if you don't give them an accounting, it could be 20 years.
Yeah.
hmm When
Yeah.
all the money is gone from the trust that would pay the litigation costs.
Exactly. And I've experienced where um it's not the beneficiary themselves, but maybe their power of attorney, their child, their spouse that
Mhm.
comes back later and says, "Well, what happened here? I don't think my mom got all the money she was supposed to get, or, my wife or whatever." And, that's why I like to have those approvals and distribution receipts and all the things, because that way I can pull them up. And people
Mhm.
always say, "Well, I'll have all the canceled checks." And I have to find a nice way to say, "But you might be dead.
Right.
How am I going to get access to your files, 25 years from now when maybe you've passed away?"
Mhm.
Yeah, so trust
Very
accounting,
important, Lori, we agree.
yeah, very important. And it probably
Yeah.
makes your job with taxes easier too, right?
Here, yes, because the trust accounting contains, right, the assets that are on hand at the beginning of the accounting period. It shows the income and expenses throughout that accounting period, and shows the assets on hand at the end of the accounting period. Um, and we always do the accountings in the format required by the court, just in case it's ever needed to be presented to the court. Then it's already done. Nothing needs to be changed. And
Probably a
so,
good check and balance too for the accounting and for the taxes, to say
mhm,
this is what the income and this is what the expenses were, because obviously that should match on the tax return and the accounting, right? So it's a good way to check your work.
Exactly.
yeah,
Exactly.
yeah,
Beginning plus additions minus subtractions equal the end. Yeah,
right.
Hmm.
it helps us a lot.
And the assets, it's good for people to see what all the assets are, if there are vehicles or things that wouldn't show necessarily in the ins and outs of the income and expenses.
Hmm.
But at some point those will need to either be sold, or something will need to happen with those things. The accounting is another way to track those assets that aren't showing activity in the income and expense portions.
It could have been distributed.
Yeah,
Absolutely.
right. Well,
Art.
we're really pretty far into our podcast here, but when we were preparing this, we talked about some common problems or concerns. So I
Mhm.
wanted to just touch on some of those, because they are common, and wanted to just run through those with you guys. So, like, uh, property or assets the beneficiaries don't want to share. That, what do we do in that situation?
So, from a tax perspective, especially in California, in terms of property tax reassessment and things like that, if a property is going to be divided between siblings, and nobody's going to be living there, that property tax is going to be reassessed. So they're looking at some increases there that they may not have expected. And it's always difficult when you're owning a property with a sibling and one of you wants to sell it and the other one wants to hold on to it. So, oftentimes it might be good on the estate planning side for there to be kind of a map for what should happen in those instances, or what should happen,
Yeah,
should
the
there be.
property tax has become a real, since Prop 19 was enacted, it's become
Mhm.
a lot bigger issue.
Absolutely.
And also, I feel like there's been some changes with the county where the speed with which things are happening is not the same, including
Each
the supplemental property tax bills, which is another reason why, we were talking about earlier, like the trustee just being able to walk away. Well, we're not getting some of these supplemental property tax bills for 18 months.
Right.
And that's,
lease for 2 and 3 years.
Yeah.
yeah, it's crazy. So, but yeah, and then of course, as an attorney, when we've got these issues of, well, beneficiary, of the trust that's not my client wants to keep the property, and trustee is going to get money, who's applying for that parent-child exclusion with the county for that person that I don't represent? Does it my client's duty? So that's something we've had to work out,
Yeah.
But yeah, it can make it really complicated.
And many
Um,
times siblings want to continue co-owning rental properties that their parents had. The first step is going to be important that they understand what's going to be involved in that, but then to remove that from the trust of the estate. Maybe that's just tenants in common ownership. Maybe they form an LLC, but the property is distributed out of the trust or estate. Get it out of the entity. We're working to allow this to terminate and set up a new entity for
right.
its continued running
Yeah, there's
operation.
a lot of
Mm.
issues that come up around that and the co-ownership, and a lot of times I'm like, well, I don't really want to be involved in it. You know,
Right, right. Can we
give me
just
the
flick that
business
out?
authority to figure out the LLC, and you let me know where we're distributing it. Yeah,
One more piece on that property tax assessment, that supplemental one that comes. That's another reason that we talk with attorneys and talk about that reserve that should be held after the trust or estate is closed. Because if a property has been sold and there's potential for that supplemental property tax bill to come, the trustees distributed the money and this bill comes that has to be paid. It's important that there's enough of a reserve to cover that
yeah, and
cost.
those I've seen them be quite large.
Yeah, absolutely.
Yeah, uh,
Multi-year and quite large.
yeah,
Right.
exactly.
A
Yeah.
lot of times people will hold on to a property for a while if they want to make improvements, if they need to clean it out and to, deal with the family's personal effects. That can take some time before it's ready to be sold. But if nobody's living there during that time, they're not taking that, um, property tax exclusion. So if then they're going to have this supplemental assessment that they're going to have to deal with for all those months where it didn't sell.
Yep. No, absolutely. So another issue, which is near and dear to my heart because this seems to happen all the time,
Mhm.
is when an IRA or retirement account or investment account just gets cashed out somehow.
Ooh, ooh.
Yeah, seems to happen a lot. And I know with some of the institutions, if somebody contacts them, their first inclination is to say, "Here's like a cash out form," and that I don't even think the beneficiaries know that that's what they're being given,
Right.
or that they know what's gonna happen, and, it usually is happening outside of the trust,
Mhm.
so I don't know about it, but it's all interrelated and a problem.
Generally speaking, retirement plans are fully taxable. Roth IRAs have a special exclusion, but IRAs, 401ks, they are fully taxable. When someone dies, that doesn't change. And my first advice is if they exist, don't do anything until you talk to Lori, because there are a lot of options here that once you cash out, you've lost, and
Mhm.
100% taxation immediately. We could go on and on about horror stories about people that filled out those forms, Lori, and
Mhm.
they were contained in an estate, and you had a whole lot of income in year one, but because it was under the jurisdiction of the court, distributions could not be made until year two. So suddenly that IRA was subjected to a lot of taxation.
Mhm.
Right, because if we can make distributions, then usually we can offset that or pass it through the beneficiaries, right?
Pass it through to beneficiaries. The first line of defense is going to be to see what qualifies for a rollover IRA. There are different rules and different methods to accomplish it.
Mhm.
Some administrators will apply what's called the look-through rule.
Mhm.
They'll look at the trust agreement and say, okay, well, even though it's payable to the trust, we can see that the three kids are the beneficiary. So we will allow them to set up an IRA, rollover IRA into their names.
Mhm.
That's going to depend on the administrator whether that's allowed. But circling back, don't do anything. Let's explore these options to see what's possible.
Yeah, that's the biggest, I think, takeaway is don't go take these actions because they can have big implications.
Hmm.
Definitely. What about RMDs? How do those play into all of that?
The rules on pension plans are very complex. And generally speaking, if RMDs, required minimum distributions, were begun by the decedent, they have to continue in the estate or trust administration. Many investment administration firms will contact you and let you know that they need to be taken and when. Depends on whether or not they were started before the age of the decedent, but it's something that has to continue to happen.
Interesting. Well, and sometimes I think maybe people didn't take them if they were ill or something. So there might have to be like some catch ups after trustee
Mhm.
steps in. I know that happened in one of my cases where it was like, oh, geez, they didn't take what they were supposed to take, and we got to figure that out.
And
So,
there's ways to the penalties on failing to take them are huge. The excise tax can easily go to 50%,
oh,
but
geez.
there are easy ways to get IRS blessing to avoid those penalties. Certainly, health and illness is one.
Yeah, definitely. So another common issue can be difficult beneficiaries. Never dealt with that
Mm.
before.
Oh, right.
You've never dealt a case that didn't have at least one.
It seems that way. I always say to my clients, I said, there's one in every family, and if you don't know
Absolutely.
who it is, it might be you.
Oh, do you say that? That is hysterical.
Oh my gosh, that's so
Uh,
Oh,
yeah, I think just our goal is really for trustees to be covered and for us to give them that, paper trail of having an accounting to cover, what they have done, that show that they've filed all the tax returns, having conducted that tax
yeah.
research. These are just big pieces that I
Well,
think
and
play into.
obviously we don't want difficult beneficiaries because they can
Right.
make our lives harder. They can make the administration more expensive. But
Mhm.
sometimes it's almost better if you have a difficult beneficiary because then we're going to do everything by the book. It's very easy
yeah.
to tell your client why we need to do it by the book. It's the ones that where they're like, well, we all get along. I don't see why we have to do that. Those are the harder ones to get them to, dot all the I's and cross all the T's.
Mhm.
So sometimes it can be a little bit of a blessing to have somebody that, they don't get along so great or they're going to be looking over your shoulder because then I can, make sure it's very easy to convince my client to do what they're supposed to do.
Yeah.
It's difficult because the siblings are grieving, the surviving spouse is grieving,
Mhm.
and what might be a cohesive family gets strained. And like you're saying, Lori, you all got along great at the beginning, but towards the end, bickering happens. Well, I don't know why you were selected as a trustee.
Yeah.
You were always the favorite child, and these sandbox type relationships surface again.
No, absolutely. And I know a lot of when I used to do a lot more litigation, I don't really do any now, but a lot of the litigation would be the siblings that all agreed on some course of action. A lot of times it would be, oh, Sue, you can live in the house. No one cares. No one wants rent. And then 5 or so years go by and they're all like, well, wait a minute. Did you ever even distribute the trust? What has happened? And then, the trustee comes in and goes, well, they all said it was fine. I'm like, well, where do you have that in writing? No. Well, then we got a problem.
Right.
And define fine. They
Yeah.
can live there for 1 year, 2 years, rent-free, modest rent. Define it.
Yeah, exactly. Nothing in writing. You don't stand a chance.
Mm, mm,
Another challenge can be co-trustees. And I always advise my clients to avoid that. And uh, told them our judges have asked us not to do it. I've told
mm,
them that for practical reasons, it's difficult. Like both trustees have to sign the tax return, right?
mhm.
It's just both of them might have to go into the bank together, which isn't going to work well when one lives in New York and one lives in Washington. And,
horrendous.
Yeah.
Caused a lot of work and a lot of additional administration.
Mm-hmm.
Yeah.
And so, giving them independent powers sometimes is helpful with that, so that, like, it says in the trust, one trustee can bind the trust. That sometimes can help.
Right.
Um, but there are banks that don't allow that now. And
Right.
then there are banks that require that. So
Right.
it's a little frustrating because even on the estate planning side, I'll do a trust for my client and they'll say, we want the language to be one way or another. And then the client comes back and says the bank doesn't like the language, but one bank wants one thing and one wants another. So it's like, it's just going to depend on your bank. But yeah, co-trustees can be difficult. Another big source of litigation, because if
Mhm.
you've got two, there's no majority rule. They're in a stalemate if they can't make a decision.
Mhm.
Mm-hmm.
And the tax forms are generally set up just for the one signature. We kind of squeeze them in there together, but it's much easier just to have one person to go to, one person to sign. It works out a lot better. We can have, quicker communication, quicker response time, that kind of thing.
Right, exactly. Yeah. Well, we've gone quite long today, but I was, for me at least, a
I
very
like to talk.
interesting discussion. I mean, they're just, things that come up all the time that I'm coming to you guys with, and it's good to, talk about those, hopefully make some people out there aware of the different issues that arise when you're a trustee,
Yeah.
and things to be aware of.
Mhm.
And and for your trustee, so if you've got your son or daughter appointed, you can say, oh, geez, there's a lot of things that they're going to have to do. So it's good for people to be aware of what they're asking their trustee to do as well. I always say you're asking them to do a job. This is not an honor. This is
Right.
not,
Absolutely, Lori.
this is not a walk in the park. I've had clients that have taken sabbaticals from work in order to be a trustee.
Correct.
And some can be more work than others. But, always trying to make sure my clients know what they're asking their trustee to do. And I think this helps a little bit, at least on the tax side, to say, okay, well, here's all
Mhm.
the things and the liability, that you're asking
And
someone.
therefore they should be paid.
Yeah.
Absolutely.
Yeah.
The thought is prevalent with my mom and dad, I would do this for them. But when you have to take a sabbatical or, like you said, a second job just to do this work, you should be compensated.
Right.
Especially if your, sibling is being horrible and difficult.
Correct.
I have some people that are like, oh yeah, and after this, now I'm taking, after they did this, I'm going to take this fee. So yeah, but no, I think it's good. It's, helpful for people to know all the issues around this. So thank you for being here and for being my guest today.
Thank you for
Course.
inviting us, Lori.
Yeah,
We
Yeah.
always love
fill the
talking with
void of
you.
Lauren not being here too, having two of you. So that was nice.
Yeah.
So if you want to find more information about Daryl and Katherine, you can go to golembcpas.com. And to find us, you can go to lawgbs.com. So thank you again for being here. And for everybody that tuned in today, thank you for being here.
Thank you again, Lori.
Thank
Yeah.
you.
You've been tuning into Simplifying the Complicated with your hosts, Lori Bolander and Lauren Gallagher. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, lawgbs.com. Thank you for your positive feedback, comments, questions, and for sharing this show with others.